Hey, I'm Steve Saporn from Aloha Capital, and getting the opportunity to sit down with Dean from Alexis and Dean fame. And it's an interesting thing, Dean. The way that you're teaching people about finance is actually kind of the way that I learned. When I was younger, my brother was 13 years older and really smart about finance. And I used to just walk into his office and ask him questions. And over time, he told me things and I learned some things, and now it's my career. And one of the ways that I found you, which I thought was really interesting, is that dynamic is happening with my son now, who's 16. And I turned him on to your channel and he's watching your videos. And we were just watching your one about McDonald's the other day, and talking about how that, their sales are slowing, and, they're kind of putting it off as um, the slowing economy and consumers buying less. But it was actually Apollo's thought. He mentioned, what about Ozempic? And I thought that might be a really interesting reason for McDonald's sales slowing down. That's outside the kind of current norm.
My perspective is more so a little bit looking at what fast food's known for all these years, right? Like, you always think of fast food as when it's an affordable thing. It's when, like, when I was in college or whatnot, right? You go eat fast food because it's cheap, right? It's no longer cheap right now for various reasons. Right. I think, again, this is just my opinion. The structurally fast food has changed now, right? Because of they bumped their prices up. It's only because they to maintain their gross margins, right? They're just shrinking because of, I would think, cost of labor, and also the tail end effects of the pandemic, supply chain issues, and so on and so forth. But fuel costs with inflation, their cost has just gone up, and they can't offer the same product for the same price points that was once deemed as, hey, if you don't have any money, go eat fast food. It's the only thing you can afford, right? So, I think there's a structural change going on here with labor costs. I think either they figure out how to manage that, going forward, to bring the prices down, as you see them trying right now, right, with these $5 menus and stuff like that, or there's going to be something significantly different about the way we look at fast food, in the F&B industry going forward. Because if you think about it right now, there's a lot of non-fast food places you can eat at, which technically is not as processed. It's technically, from a food standpoint, it's better for you, right? It may not be necessarily healthy, but it's a whole lot better for you than eating, a burger that you have no idea where it's been in the last 24 hours, right? And it's cheaper. People get more for it. I heard something the other day where people go to Olive Garden now instead of McDonald's, which they get a lot more bang for their buck. So I think there's some sort of structural change happening right now. It was a $300 stock where it ended up, and all the problems they had. That would be a good example of, you buying something where structurally the premise of that company and investing in it hasn't changed. It's just it had a little blip, with that E. coli thing. Management comes in, fixes that, and look, it just went on a run. So I agree with you. I don't think McDonald's and the fast food industry is suffering that. It's something bigger, something much bigger structurally that they're going through right now.
Yeah, that's funny. I actually bought Chipotle right at that time for that reason, because the E. coli thing, and they were like shutting down stores. And I really like the fact, I think they were the first sort of fast casual restaurant that went all non GMO, and they had the advertisements about, not having any freezers there. And that was the kind of thing that I thought, for sure they will figure out how to not give people E. coli. It's pretty major restaurant, and that's a pretty low bar. Now this is different, so it's an interesting thing. And you have a lot of people that are following you, and it's important for them to think about the whole picture when they're getting into stocks and all that. So I think that this was instructive for people learning.
Yeah. Yeah, and we have this thing with McDonald's too. So there's this little thing that I have with McDonald's that started a while back when I talked about an Egg McMuffin costing $6, so that's kind of where the McDonald's things comes
Yeah.
from.
Nice. And then the other part that I thought was really interesting, once we got to know each other a little bit, our companies really interact with each other really well to provide the kind of the capital that Aloha as a private lender still uses bank money. And you know, our two kinds of firms actually interact well to deliver borrowers a different kind of credit. You know, from your view, what is the role of the traditional banker to help a small business like mine out, and how does it work, and what do you look for in a good client?
Right. So, I mean, just for the audience, like, I'm a commercial banker and you're, in private credit. So, a little background is, banks, like mine, like in my industry, we lend money to, companies like yourself as in what we call a warehouse line, and you go out there and you originate, you write up paper, and you provide that back to the bank as collateral, and we give you an advance rate so you can go out there and do another loan, basically. So that's kind of the relationship, so everyone understands. And I think I think what it's key in the marketplace is what we do for companies like yours is allow you the liquidity and the capital to do what you do, is because, banks, are federally regulated. There are a lot of things that we're limited by because we're holding depositors' money, for example, as opposed to a private credit firm like yours, where you're not taking deposits, you're using, equity capital or debt, basically, which you get from banks like me, or an equity capital from your investors, right? And you lend that out. So the landscape is very different regulatory wise. We're so limited on how we can lend. Whereas, private credit companies like Aloha is different, right? You guys have your criteria, your lens of risk and return is very different from a bank's, right? I would say sometimes almost like in a different planet sometimes, right? We all want to make a return, but we've got so many different forces, that limit what we can do. Whereas, you were the same, you want to make a return, but you have different forces that come into play. So, like you mentioned before, we work really well together because we look at companies like yours. We look for a good track record. We look for your ability to get repaid because we're going to lend money against the notes that you generate. The loans that you make, we lend you against those loans. So we want to make sure things that we look at is to make sure that, you've got a great track record, that you write low, how you underwrite your loans, what's your risk management policies in there, and it goes all the way through the usual, the KYCs and the AMLs, and that's all regulatory as well. We look for stuff like that. And, we underwrite to make sure that, based on our standards that, we get paid back, and we make enough of a yield to make it worth the risk that we take.
So we started, as a private credit firm. And for a little bit of background, I mean, what Aloha does is it's a business to business lender for people in the real estate industry. So they might be doing fix and flips. They might be developing ground up construction for 17 townhomes. They might be buying a portfolio of built to rent homes. So we operate only in the business to business lending world. And that, like you mentioned, is regulatorily a different animal than a bank. And we have a lot more freedom there. And originally, all we had was our own capital. So it was a several $1 million fund. And what was happening is we were finding great borrowers, but we were all loaned out with loans that were performing. And by affiliating with like a larger institution to give us a line, it just allowed us to more efficiently run our business and serve our clients. So it's been a huge benefit to Aloha as a small company with limited capital to be able to expand. And it's interesting, we don't do commercial. I mean, we don't do consumer lending, But, for people who've gotten their own home loan and had that hassle of it's just a nightmare process in dealing, one of the reasons why is it's pretty much the same setup as Aloha has when we sell our loans off to the securitization market. As a mortgage loan originator, we have all the guidelines from the banks that we get our line of credit from that, Dean would offer us. And then we also have a whole set of guidelines that the loans that we originate have to meet. And sometimes those are 80-page documents. And so if we do it wrong and we can't sell it, it's a real hassle for a mortgage loan origination firm. And that's why I think the process becomes difficult for people, because you have multiple sets of eyes on this thing, and a new person comes in from one of the banks or lenders or us and says, oh, the zip code is wrong here or whatever, and you start a whole process over. But so that's just sort of a reason why I think people get frustrated with the lending process in general. You have multiple institutions who are trying to protect their assets wisely. And it's interesting. I saw a post from you just in the past week or so about build to rent. And that's something that we actually finance a lot of. And you were talking about how it's a really good investment with rates that are high now. And I think investing in the Fundrise Fund, which I've invested with them, they're a great company. I like their vehicles. I literally just got home from a trip where I bought a portfolio of build to rent homes. And I was doing a 1031 exchange and coming out of a shopping center in Florida, and I moved it into a portfolio of homes, which was really great. Got me out of an area where insurance rates were rising rapidly, kind of giving me a lot of fear about whether my investment that had been an incredible investment for nearly 30 years was going to even be. And I think the risk reward of these deals is just one of the best investments that I've ever seen. I mean, our company is 9.5 years old. We've financed over $1 billion of real estate, over 4,000 loans, and less than 0.5% of those have gone into default. And actual money losers, I think it's less than four or five total. So it's like anything, there's risk to our investment. But I do think the risk reward profile of private credit, and to your point, done right with good underwriting guidelines, provides people a unique investment that can really be of benefit to their portfolio.
Yeah, and also, I mean, just on a side note, I tell my clients a lot, and I tell friends and clients too. Someone comes in and a developer comes to you and asks for, or an individual investor comes to you and asks for a fix or flipper loan. Like I get those requests too. A lot of times they don't understand when they get declined. I think what a lot of borrowers miss out is like, hey, we're not declining you because you don't believe in your project. It doesn't pencil. It's not a good investment. So I tell either my borrowers, my friends who are investors in these things, like, you have to look at your lender's underwriting and take it not just as, hey, I need to pass it so I get my money. But if you fail it, there's something wrong with the investment you're making, because our job is to make sure the investment pays off, because that's the only way we get repaid. I think that's an interesting thing that a lot of borrowers out there don't quite see, that if you get declined, just bear in mind, like, we can't, there's too much risk in that deal for any lender, whether it be a bank lender or a private credit lender. If you get declined, that for us to take that risk. So you might want to go back and look at your investment. May not be a good one.
Yeah, I mean, it's very instructive, because we have set up and we are aligned with some of Wall Street's largest firms and have their data and guidelines. And we are setting up our guidelines so that we get paid back. But that means that the borrower has been successful. So when somebody doing a fix and flip or private deal, and they come to us, essentially they're complying with your guidelines as the commercial bank lender, with Wall Street's guidelines, as well as ours, and they're all set up. I mean, you know, banks and private credit people, we're here to make the most money possible in the least risky way that
Right.
we can do it. And I think on both sides, certainly your firm and our firm has done a good job
Oh,
of
yeah.
it. And I really think your point, you know, if people are interested in finance, it's just something to poke around on and learn. You know, I remember reading about Warren Buffett, and you know, his strategy is incredible, and he's an claimed investor. And one of the things is he would buy these cash flowing companies like railroads and insurance companies, and they were sort of the core of his portfolio, with a pretty concentrated selection of stocks around that. And, you know, I don't know about you, Dean, but I can't buy myself a railroad or insurance company yet,
Yeah.
but I can invest in these
Yeah.
private credit notes. And so I've kind of taken the Steve Siporin version of Warren's
Yeah.
strategy and create the cash cow businesses as our private lending notes. And then I invest in things like crypto and, you know, Apple and Amazon in a much more kind of concentrated way than I would feel comfortable in without the base of private credit to just dampen out my volatility. So it's an interesting thing how our firms work together, how the way you're teaching the world to invest is kind of similar to how I learned about it. And you know, I've had a really enjoyable time in this conversation and hope we can do it again.
Yeah, absolutely. Well, this was good. And I think it's good to let the audience understand a little bit about private credit. It's such a buzzword out there. And I think that was good that people understand better how, you know, capital flows from, you know, depositors into a bank, and from that bank it's loaned out to companies like yours, and it all flows out into the economy, into you know, specifically into a segment right now that you and I know is the demand will be here for several more decades, because the housing is just a shortage in general. And this is how, you know, we put capital to work to meet that demand, basically. So
Yeah, I mean, you know, it's a really important thing. I mean, you know, we are doing that obviously for our own personal gain and to serve our clients, but it really is something that is helping the
yes.
country. And as far as the, you know, the investment, that's one of the reasons why I'm just so high on the single family space, and in general, just residential mortgages and lending. On our end, we see what the big Wall Street capital wants to buy as far as loans, and by far it is residential real estate over
Yeah.
commercial deals and all
Yeah.
that.
Yeah. Yeah.
Everybody knows that this market is in a structural thing, that it's set up to make money, you know,
Yeah.
until you and I are long gone.
Yeah. 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 Yeah.
Well,
We
I
won't.
hope
We
we'll
won't.
live a little bit, Dean. I
Yeah.
hope we'll have a long one.
But you're right, though. I don't think we're going to catch up with the shortage, with the way the population's growing and with, you know, all the nuances out there for housing right now. I think we've got a ways to go, and there's opportunity, right? You know, investing is always about finding a gap out there and finding an investment that fills it. So here we are.